The last valuation model that I'm looking at is a cash flow model. Please pay attention to this because this is also a reminder of what you've done before, both in investment appraisal and cost of capital. However, there are some little differences that you need to take note. If you don't take note, it can make the whole of your calculations to be wrong. So please pay a good attention to this. Right. So what this method is doing is combining the time value of money approach and earnings approach. So I'll say this is a combination of time value of money, and earnings concepts. So which means we'll be looking for earnings and at the same time we'll be doing some discounting. When we talk about time value of money, it means that there will be a reason to discount future cash flow. That's practically what we are talking about. So you should be anticipating that. And why are we talking about that? It's because in this method, price or value of a company is deemed to be equals to present value of all future cash flows. So, which means to determine the value of any business, to determine the value of any asset, you need to estimate how much cash flows will be coming from that asset, how much cash flows will I be spending on that asset. All of those cash flows, you put them together, you discount them, and you calculate the net present value. And that is your valuation using the cash flow method. So if I just quickly break it down for you, what are the steps? You see, not similar, not any different from what you know before. The first one is you must be able to identify relevant cash flows. And that is exactly what we did when we dealt with investment appraisal. To identify relevant cash flows. That's the first one. The second one is to determine the time horizon. Determine time horizon. And here we're talking about the tenure of the asset, of the business, of the project. Whether it's 5 years, whether it's 10 years, whether it's perpetuity, you need to know. Because knowing will help you to know the best approach to do the discounting that you have to do. And at what rate are you going to be discounting? Because we said this approach considers time value of money. So which means you need to identify suitable discount rates. That is, what WACC are you going to be using? Yeah, you are always using WACC most times. But please take note, this is one of the differences. In fact, I'm going to put it in red that I need to know. When we're using WACC during cost of capital, we're always calculating WACC net of tax. Please note that for valuation, you need to use WACC that is before tax, so which means gross of tax. Because you are not expected to make tax adjustment for business investors. Investors will be located in different parts of the world with different tax rates applicable. So investors are expected to make tax adjustment themselves. So what you are focusing on is the real value of a business without tax implication. So usually we do it gross of tax, except the question asks you otherwise. But generally speaking, you work gross of tax. Yeah, because most times they will try not to even give you the tax information so you don't get confused. Yeah, if they want you to consider tax information, you will be given and you'll be asked to use it. Yeah, but most times, please take note, you are always going to calculate gross of tax. Yeah, and once that is done, you know the discount rate, then you can go ahead and calculate the NPV or the present value of all cash flows. Yeah, that is, you are using this and this, yeah, to calculate the PV. And once you do that, remember, if that company has debt, it means that the cash flow that you have gotten was provided using two types of capital, debt and equity. So, which means such value will be an enterprise value, which means it has a combination of debt capital and equity capital in use. And for you to get the real value of equity of a business, so which is the value of a business, that is, if the shareholders want to sell the business today, how much would they be selling? They won't be selling with the debt. So debt value has to be taken out. So the value of the business will now be equals to the value you have in 4. So value in step 4 minus debt. So this is what you need. And with that, you get the debt value from your financial statement. You don't need to do a different valuation for that. So just deduct the value of debt from the financial statement, and you have the value of business that you are expected to get. Okay? And I'm going to work a lot of examples on this one. Yeah, because there are various things we're going to look at here. We're also going to look at debt valuation using this cash flow approach, because you're expected to know it. In fact, it's the most common part of questions you will see, right? So let's look at a question. So we have the following information for G Limited: revenue, production expenses, capital investment, debt, all of that given. The WACC is 16.6%. Inflation is at 6%. The cash flow is expected to grow at inflation rate for foreseeable future. That's perpetuity. It will keep growing at G. So G will be 6%. And now we have been asked to calculate the value of the company. Yeah, and equity, yeah, for sure. So now with the information we have, what the perpetuity growth in, formula that we know of, that's the dividend model formula that says that the price or valuation of any company is that current cash flow into 1 plus G over KE minus G. So instead of putting dividend here, I've put cash flow, because this time around we are not working with dividend, we're working with cash flow. Whether it's dividend or cash flow is the same perpetuity growth formula. So we can always adopt that formula. Yeah. If there was no growth, that means G will be 0 and price will just going to be cash flow divided by KE. Remember, this is your perpetuity formula. Yeah. This is your perpetuity formula without growth, and this is your perpetuity formula with growth. But because there's growth here, this is the formula that we're going to be using. And in that case, we need to calculate what's our net cash flow. That's the first thing we have to do. So if the revenue is 400 and it's going to spend production expenses of 150 and another admin expenses of 36, then there will also going to be capital investment. That's also an outflow of 60. Yeah. So remember, the capital investment is expected to be annual as well. So which means the net cash flow in a year is 400 minus 150 minus 36 minus 60. And that gives us 154. So remember, these cash flows are annual cash flows, so they are expected to happen every year. So 154 million every year is what we're gonna make. So this 154 million is the current year, and this is expected to grow at the inflation rate every year, which is 6%. So if we put that into formula, we have our price note is equals to 154 into 1 plus 6% over cost of capital is WACC, and that's 16.6% minus growth rate, that is 6%, because the growth is expected to be at inflation rate of 6%. Right, so Remember, the cash flow of 154 was generated using equity and debt, because there's a debt in the question, right? So that is why we're also using WACC here and not just cost of equity, right? And if you put all of that together, we are 154 times 1.06, and that is 163.24 divided by 10.6%. So that's divided by 0.106, and that will give us 1,540. So that is the gross value of this company. However, this company has debt of 200 million. So equity value, which is the value of business, is now equals to 1,540 minus 200, because this valuation includes debt, because the cash flow that we used came from the use of both equity and debt. So to get the equity value itself, we need to deduct the value of debt, and that is 1,340, and this is the value of the equity that we're talking about. Yeah, very important to know that. And also, just to mention it to you, that you know that definitely the higher the cost of capital, the lower the value of the company. So if the WACC increases, then the value of the company will come down, as you can see, obviously, in the formula. So that is just a quick workings to show you how cash flows can be used. Before I go into debt valuation, let me just quickly touch on the benefits, that is the advantages and disadvantages. For this question, if there was no growth, it would have just been 154 divided by the WACC of 16.6%. Yeah. Now, advantages and disadvantages. As you see, obviously, is the time value of money that I consider. It's an advantage, because we always have to do discounting. Yeah. Then, the fact that it uses cash flow removes accounting bias or manipulation. So there's no estimate involved. Very good. And that's why it's the best method. It works with cash flow, real cash flow. Yeah. But not all perfect, because cash flows can be difficult. So difficult to calculate all the discounting and all of that. Yeah, and there's an assumption that is not always correct. And that is the assumption that the growth rate, the inflation will all be constant forever. This is not always true, and that's the disadvantage of the cash flow method. Lastly is debt valuation. And in this debt valuation as well, we're going to be using this cash flow method. So we'll be adopting cash flow method. You need to know how to value a bond. Yeah. What you want to learn is, what is the price of a bond? You need to know how to calculate the price of a bond. Yeah. And how do you do that? It's still the application of this cash flow method, because the market price of a bond is the present value of the cash flow from that bond. So the price of a bond is the present value of all future cash flows from the bond. But please note, gross of tax. Don't make tax adjustment. gross of tax. Yeah, or you call it pre-tax. So use pre-tax cash flows. That's cash flow that you have no tax impact. Yeah. Now, if you just flash back to your knowledge of cost of capital, you remember there are different ways of calculating cost of capital. The same way there are different ways of calculating cost of capital, the same thing will be applicable to the valuation of debt. Now, we have different methods of calculating cost of capital. We're going to have different methods of calculating price of debt because it is the same formula that we are using. So which means the same way we have different types of debt and we use different formulas, the same method we will use to calculate the price of those types of debt. And that's, I'm going to just deal with the easier one first quickly. The bank loan, nobody will have to calculate the price of bank loan, so I'm not looking at that. So I'm going to just start with irredeemable bonds. Yeah, those are the bonds that you keep forever. You never redeem them. When you have those ones, you use your perpetuity formula without growth, and that is price equals to interest divided by cost of capital. Always like that. So that way to look at it is cash flow divided by WACC. Yeah, easy. Nothing more than that. If I give you a quick example, imagine you have a bond of coupon 9%. So bond 9% coupon. Yeah. And the cost of debt is 6%. Because this will never be redeemed, so there is no redemption value. What you will get every year is 9% coupon, and I've told you 9% coupon means 9 times 9% of 100 because your interest of coupon is paid on par value, and that will equals to $9. So the cash flow or the interest you will get on this bond is $9. In that case, the price of that bond, because you get $9 every year to forever, divided by 6%. And that will equals to $150. That is the price of that bond because it's irredeemable bond. Yeah. And as you can see, the price is always inversely proportional to the cost of debt. So imagine if you increase the cost of debt to 15%. You can see the same bond. Yeah. If the cost of debt, which means the required return from the debt holders, goes to 15%. Maybe the economy is doing 15%. That means any investor will not want anything less than 15%. What happens to the price of that bond? The price of that bond will go to $60. See, the bond will crash because the economy, the market is doing 15%. So that bond cannot be doing coupon of 6%. And that is why price will come down to 60 because the demand of that bond will crash. Nobody wants it. Okay. Another type is the preference shares. Preference share is similar to redeemable bond. So it's the same formula. Price will also be equals to the dividend, which we'll call interest in the case of the irredeemable bond. Yeah. It's similar to what I have, cash flow over WACC. Similar to your perpetuity formula. It's the same thing. So similar approach, similar calculation. Where we'll spend a bit of more time is the redeemable bonds and convertible bonds. And if you remember, they are very similar, but just slight difference. I'm going to work a calculation for you to remind you. I know you probably remember we've dealt with this very well when we were talking about cost of capital, right? So for redeemable bond or convertible bond, is similar approach. Remember, the valuation is the present value of all future cash flow. But in case of redeemable bond, this will be present value of interest, which is the coupon, the annual coupon you get until redemption, and the redemption value. Redemption value. Usually, most of these bonds are redeemed at par, but sometimes the question will tell you that some of them are redeemed at premium or at a discount. But for convertible bond, the price or the value of that bond will be present value still of the interest, which is also the coupon, and this time around, not the redemption value, but the higher. That is why we always test for conversion for convertible bond. So what we are saying variably is that if you have a convertible bond, there are two valuations you can get. You can get a floor value, or you can get a market value. So if you use redemption value, disregarding the conversion value, what you will get is a floor value. That is the price. The price you get is called the floor value. Why it's called floor value is because that should be the worst case scenario for that bond. Because if the conversion value gives higher value, then that should be the market value. So which means you always test for conversion. If the conversion value is more than the redemption value, then you use conversion value as your last cash flow plus the interest. If the redemption value is higher, then use the redemption value as the cash flow plus interest to get the present value. And in that case, when you use the redemption value, what you are getting is the floor value. And I will use an example to actually explain this. But before I go into that example, just to mention that you should remember that your conversion date might not necessarily be the same as your redemption date. So you need to watch out for that. I'm sure you probably saw one or two examples when we're doing cost of capital, when a 10-year bond might be convertible in 6 years. So when you are doing your calculation, you need to be calculating the conversion value on the conversion date, and you compare that with the redemption value on the redemption date. Okay, so very important to know. Yeah, they won't give you anything too complicated. Mostly they will, if they want you to do something like that, you realize that your conversion value even before the redemption date is already higher than the future redemption value. So it's no brainer that you take the value that is higher, even closer date, than going and waiting for redemption value in the future that will not even give you as much as conversion value. Let's look at a question to take care of this one. Yeah. So we have this company. Let me split the view. This company A. Company A has 11% debt, redeemable in 5 years. Redemption will be at par value. The investors require a return of 8% gross. That is cost of capital. The bond may be converted into 20 shares in 5 years with a current value or current price of 4.4 shares. Share price is expected to grow at 7% per annum. And now we have been asked to calculate the floor value of the bond, and at the same time we should calculate the market value of the bond. So it is very possible that the market value will be the same as floor value, but that will only be the case if the floor value is higher than the value of the bond calculated at the conversion value. But let's find out, first of all, what is the floor value of this bond. Floor value means that we are just going to assume that this bond is just a redeemable bond without a conversion option. So take note so that you don't get confused. Anytime you are asked to calculate floor value, what we're saying is ignore conversion option. Yeah, that is, you are treating it, so treat as just a straight redeemable bond. That's what floor value is talking about. So if we're going to treat it as a redeemable bond, it means that we need our interest, so we plot our cash flow as we normally do it. So we have 5-year bond, so year 1 to 5, that will be cash flow, which will be interest, and that interest is 11%, because that's 11. And on year 5, there will be a redemption at par, and that will be 100. So we need to get a discount factor. At 8%, because that's the required rate of return. Yeah, so annuity for 5 years is 3.993. If you don't understand how I'm getting this, in case probably you are watching this video and you have not watched the earlier videos on investment appraisal or cost of capital, I'd advise you to go watch those videos first. And that's why I'm making this video as last video, because it's premised on the fact that you have watched cost of capital video. And that is the best way to study FM, right? So the discount factor for 5 years will be 0.681. And the present value for these figures will be 43.92 and 68.1. So the floor value total, which is the present value, is addition of those two, and that is 43.92 plus 68.1, and that gives us 112.02. So the floor value of the bond is 112.02. So this is the same approach you will use, assuming that this is not even a convertible bond. If they ask you to calculate the price of a redeemable bond, this is the same approach you will use. You can see I did not adjust for tax and my interest, and I just calculated the PV and added it together. Yeah, that is the floor value, and that is the first part of the question. Now we are also asked to calculate the market value. So before we can calculate the market value, we need to find out what is higher, test of conversion, between the conversion value or the redemption value. So what is the redemption value? So redemption value is the value of shares that is equivalent to one bond. So one bond will be equivalent to, according to the question, 20 shares. Now, one bond in redemption is $100. What is the value of these 20 shares? That is 20 times price. So we need to know the price in 5 years' time. Unfortunately, we only know the price today, which is 4.4. Yeah, but in 5 years' time, they said it will grow at 7%. So that means multiply by 1 plus 7%. So the present value of this price is 4.4. It's going at 7% over 5 years. And in that case, that will give us 4.4 multiplied by, let's see, 1.27 raised to power 5. That is 1.4026. And that equals to, this times 0.4. That's $6.17 per share. So the share price in 5 years' time is expected to be $6.17. So, and 20 shares is one bond, and that will give us times 20, and that means the conversion value is $123.4. And if you compare that to redemption value of 100, obviously this is the way to go. So a conversion will take place, and just the same way we've done this, we're going to do the same thing. However, instead of using 100, we're going to put the conversion value there, because that is the best value obtainable. So going to have our cash flow to year 1 to 5 and year 5. So we're still going to have interest of 11. However, we're going to have a conversion value at the end of the bond life. The discount factor will still be at 8%, which is the WACC, gross of tax. 3.993 remains our annuity factor to use. Discount factor at 0.681, and we get our present value of same 43.92. However, the second one will be different, and that's 84.05. So you can see it's a similar approach that we've done here. So we'll add everything together. So 43.92 plus 84.05, that gives 127.97. So which means the market value of this bond is 127.97. As you can see, using conversion value, we have more value for the bond than the floor value. But floor value only shows you the minimum value obtainable from that bond. Right? So in that case, investors will definitely go for the higher value, and that is why the value of the bond will be 127.97. And that is it for the question. That is it for business valuation as well. And that is most importantly the hit. That is the end for financial management paper. We'll keep doing revision. And remember, if you have any question, confusion, concern, please feel free to reach out to me. I'm more than happy to support you in this journey. Thank you, and bye for now.